Welcome back to the deep dive, everyone, here on the One More Bitcoin channel. Today, we are tackling, well, probably the most critical and I think the most paradoxical player in the entire crypto space, Tether or USDT.
And we're not just here to talk about its size. Today's deep dive is really about the uncomfortable truths that were dug up in the One More Money blog. We're focusing on the core risks that just pushed Tether's stability rating to the lowest possible score.
Exactly. So our mission today is to unpack this idea of Tether's weak rating, insolvency risks, and compliance pivot. And it really is a huge contradiction, isn't it? On one hand, you have Tether reporting these, just jaw-dropping net profits of $13.7 billion in 2024.
Right.
And on the other, S&P Global hands them a weak rating. So how can this giant be so incredibly profitable, yet so, well, structurally fragile?
That's the multi-billion-dollar question, and it's what keeps regulators up at night. To really get why this matters, you have to grasp just how systemically important Tether is.
Yep.
It has a circulating supply now over $184 billion.
Wow.
It controls more than 60% of the entire stablecoin market. It's not just a stablecoin. It's the fundamental liquidity layer for almost every major crypto exchange and the entire DeFi ecosystem.
So if Tether has a problem, it's not just Tether's problem.
Oh, it's everyone's problem.
Yeah.
If Tether were to collapse, a serious de-pegging event where people can't get their dollars out, the liquidity crunch would seize the entire market. It wouldn't just be a crash. It would be a potential systemic failure across Bitcoin, Ethereum, everything. And what's fascinating here is that its own success is what's driving this risky behavior S&P is flagging.
Okay, so let's start with that engine of success. The One More Money blog calls it the free money printer. How exactly does Tether just print money?
It's a beautiful model in its simplicity. So you deposit your US dollars, and Tether issues you an equal amount of USDT. But the key is they pay you 0% interest on those dollars you gave them.
Right.
Then they take that huge pool of capital and invest it mostly in short-term assets that produce a yield, and then you pocket the entire spread.
And the scale of that spread is what's just mind-blowing. We mentioned that $13.7 billion in profit for 2024. But the part that really got me was the human element of that.
Yeah, that's a great point. We kind of forget how lean these crypto operations can be. The One More Money blog pointed out Tether does all this with only about 150 employees.
150.
So if you do the math on that, it comes out to roughly $93 million in profit per employee.
Just to put that into perspective for you listening, that figure absolutely dwarfs giants like Goldman Sachs or JP Morgan. Their profit per employee is just a tiny fraction of that. It just shows you what an efficient machine Tether is for generating yield.
But that efficiency, that drive for yield, is what pushed them into riskier territory. For a long time, the bulk of their reserves, we're talking over $120 billion, was held safely in U.S. Treasuries. In 2024, with interest rates around 4.5%, that alone generated a risk-free income of about $5.4 billion.
That sounds like a pretty solid business. Why would you mess with that?
Because they saw a threat on the horizon. The Federal Reserve was signaling rate cuts for 2025, which meant those juicy Treasury yields were going to shrink. So to keep that incredible profitability going, they made a very aggressive pivot. They started diversifying into non-interest-bearing risk assets.
Bitcoin and gold.
Chiefly Bitcoin and gold, yes.
Yeah.
They basically traded a guaranteed yield for potential capital appreciation.
And that chase for yield, that's what seems to have triggered S&P Global. In November 2025, they downgraded Tether's rating from a 4, which is constrained, all the way down to a 5, which is weak. That's not a small adjustment. That's a huge red flag.
It's a fundamental statement. S&P is essentially saying they no longer see Tether as a conservative money market fund. They see it as an aggressive, sort of volatile hedge fund. The downgrade implies a real lack of confidence in their ability to hold that one-to-one peg if things get rough.
Okay, so let's unpack this. The One More Money blog laid out 4 critical factors S&P used for this downgrade. Let's start with number 1, the change in what they're holding.
Right, high-risk asset exposure. S&P highlighted that their holdings of volatile assets, so Bitcoin, gold, some corporate bonds, had surged from 17% of their reserves to an alarming 24%.
24%.
That single shift radically increases the volatility of the collateral that's supposed to be backing $184 billion in liabilities.
And factor 2 gets right to the scary part, the insufficient capital buffer, their equity cushion.
This is where the math gets really, really thin. The equity cushion is Tether's own money, the shareholder equity they can use to absorb losses before those losses start eating into customer funds.
And that buffer is...
It's only about $6.8 billion. That's just 3.9% of their total assets. Now, if you compare that to their volatile holdings, the fragility becomes obvious. Tether's Bitcoin holdings alone are worth around $10.3 billion.
Wait, hold on. Their investment in just Bitcoin, one single asset that can drop 30–40% in a bad month, is $10.3 billion. But their entire safety net for all their assets is only $6.8 billion.
That's correct. The value of their Bitcoin is significantly larger than their entire capital buffer. So in a sharp downturn, they are completely exposed. It's a razor-thin margin.
Okay, so the last two factors are less about the math and more about trust, which is just as important. Factor 3, transparency issues.
Yeah, and this has been a criticism for years.
Yeah.
Tether publishes these quarterly attestations, but they still have never submitted to a full, independent audit by a major firm. An attestation just says the assets existed on a certain day.
Right, it's a snapshot.
Exactly. An audit provides ongoing assurance. That lack of a real audit, plus the fact they're not very open about their banking partners, creates this information vacuum that S&P sees as a major risk.
And the fourth factor, asset segregation, that's a more recent concern, right?
It is. After they relocated, S&P raised serious concerns about whether customer funds are legally segregated from the company's own trading funds. If those funds are commingled in a crisis, Tether could potentially use customer deposits to cover its own trading losses. That just breaks the fundamental trust you need in a reserve custodian.
So you put these four factors together and you get what some analysts are calling the Arthur Hayes scenario. The BitMEX co-founder warned that this whole pivot, trading stability for profit, could lead to a, quote, death spiral.
Hayes' warning is powerful because it reframes Tether. It's not a stablecoin issue anymore. It's a lightly regulated hedge fund taking huge directional bets. And when you look at the numbers, $181.2 billion in assets versus $174.5 billion in liabilities, that tiny $6.8 billion cushion is the only thing standing between stability and a complete market panic.
Let's actually walk through the math of insolvency for everyone listening, because understanding this percentage is, I think, key to managing your own risk.
It's pretty straightforward. They have a 3.9% equity buffer. Now, consider those risk assets, Bitcoin and gold. The scenario Hayes and others have outlined is what happens if the prices of those assets drop by, say, 30%.
And a 30% drop in crypto is, well, it's not a black swan event. It's a bad Tuesday.
Exactly. A 30% drop in the value of their risk assets would trigger a loss that is mathematically larger than that $6.8 billion buffer. The moment that happens, their liabilities would be greater than their assets. They would be, by definition, technically insolvent.
Bankrupt. And that's when the bank run starts.
Instantly. The market would see they're insolvent, and everyone would rush to redeem their USDT for real dollars. But Tether wouldn't have enough liquid assets to pay everyone, the peg would break, and you'd see chaos spread across the entire crypto market.
It's a really concerning picture. But to be fair, Tether isn't just sitting there ignoring this. They are making a massive strategic pivot on the compliance side. It's called Project USAT.
That's right. This was announced back in September 2025, and it's a direct answer to all this regulatory pressure, especially the new U.S. Genius Act.
We should probably explain the Genius Act. What is that?
So the Genius Act is new U.S. legislation that puts extremely strict rules on stablecoin issuers who want to operate in the U.S. It basically mandates things like 100% cash and treasury backing and federal oversight. Tether looked at its current USDT structure with the Bitcoin and the lack of transparency and realized it could never meet that standard.
So Project USAT is their way in. It's a way to get U.S. compliant without having to change their profitable offshore USDT business. So what is Tether USA or USAT?
It's a totally separate, brand new stablecoin. It's designed from the ground up to be fully compliant with U.S. law. The goal, like the One More Money blog said, is to sort of wash white their reputation by offering a clean, regulated product that U.S. institutions can actually use.
And the structural differences between USDT and this new USAT are, well, they're everything.
They're night and day. For USAT, they've partnered with Anchorage Digital, a federally chartered crypto bank, to handle custody. That's a huge layer of oversight. And crucially, USAT's reserves are promised to be 100% cash and short-term treasuries only. No Bitcoin, no gold.
And what about the commingled funds issue?
Addressed directly. USAT guarantees fully segregated client assets, which is a direct response to that fourth point from S&P.
So it looks like a classic bifurcation strategy. You have the clean, compliant USAT for the regulated US market, and then you have the offshore, higher risk Cowboy version in USDT for the rest of the world.
It's incredibly shrewd. They can potentially tap into huge institutional money flows with USAT while insulating their highly profitable USDT business from those tough US regulations. They're basically building a two-tiered system of risk.
But here's the question. If USAT is so safe and compliant, why would any sophisticated investor, institutional or even retail, keep using the Cowboy USDT knowing about its fragility in the S&P rating?
And that's the core conflict. USDT still runs the global liquidity engine outside the US. DeFi protocols, offshore exchanges, they all run on it. It's got inertia. But you're right, if all the big smart money moves to USE, it puts immense pressure on USDT to either clean up its act or face a potential bank run from its own offshore user base.
So for you listening, for the trader or investor who relies on USDT, what does this all mean? The One More Money blog recommends 3 key strategies to mitigate this risk, since you're basically lending money to a hedge fund with a tiny margin of error.
The first one is simple. Diversify. Don't keep all of your stablecoin holdings in USDT. Split it up. Move some into USDC, which is US regulated and backed by cash and treasuries. Or even look at decentralized options like DAI to reduce that single issuer risk.
And strategy 2 is all about how long you held it.
Yes, exactly. Minimize your holding time. Think of USDT as a hot potato. Use it for trading, use it to move money, but don't use it for long-term savings. Move that capital into fiat or into self-custody Bitcoin. You just cannot treat USDT like a bank vault anymore.
And finally, since this is all about the math, you need to watch the numbers.
Absolutely. Keep an eye on Tether's quarterly reports. If you see that 3.9% equity buffer start to shrink, or if you see a big crash in Bitcoin's price, the risk of a depeg goes up dramatically. The margin for error is just too small to ignore those signals.
So to wrap this all up, what we have is a company that's a titan, massively profitable, essential to the market. But S&P rates it as weak because its chase for profit has introduced these huge fundamental risks. So what's the final verdict?
The outlook has to be neutral, but leaning very heavily toward cautious. Tether is a giant, and it survived a lot. But this S&P downgrade combined with a clear insolvency math means the wiggle room is gone. Our conclusion is the same as the one from the One More Money blog. USDT works until it doesn't. Treat it as a tool for trading, not a vault for saving.
That tension between the fragility and the sheer market dominance really defines this moment. Before we sign off, we want to leave you with one final thought to consider.
Here's a question. If this new compliant USAT is successful and attracts all this institutional US money, does that actually make the whole system safer by reducing the pressure on USDT? Or does it just institutionalize a two-tiered risk model where the global crypto system ends up relying on a fragile Cowboy stablecoin that is now officially too big to fail?
That is the question that's going to define the stablecoin market for years to come. Now, as we mentioned throughout this deep dive, we do want to briefly remind you of the disclaimer that was in the One More Money blog. Disclaimer. This article is for educational purposes only and does not constitute investment advice. Investors should conduct their own due diligence before making any financial decisions. We are not responsible for any investment losses incurred based on the information provided in this article. Thank you for watching. We really, really appreciate you joining us for this crucial deep dive into the financial health of what is, essentially, the crypto ecosystem's central bank. If you're interested in cryptocurrencies, RWA, DeFi, or Bitcoin investment, please subscribe to the One More Bitcoin channel so you don't miss out on future deep dives. Also, please do like and comment below. We'd love to know what you think about this topic. Thank you for watching again, and we'll see you in the next deep dive about blockchain, Bitcoin, and crypto.